Right, higher time frame key levels. Understanding higher time frame key levels is one of the foundations of price. All of your trades need to be based on a high time frame key level. We can trade key levels in two different ways, right? So we can first trade price to the key level, right? We're using it as a drawn liquidity. So we go from higher time frame key level to higher time frame key level. Or we can trade price from the key level, right? So we use it as a potential area of reversal to then trade to an opposing high time frame key level or lower time frame liquidity. Okay, we want to blend high time frame key levels with premium and discount. High time frame key levels are going to be supercharged with probabilities once we get to the intermediate term perspective. So it's important to really digest this lesson. The 5 main high time frame key levels we're going to be looking at is old highs and lows, rejection blocks, fair value gaps, new week and new day opening gaps, and order blocks. Understanding high time frame key levels and keeping an eye on the high time frame charts also helps you keep in alignment with the narrative and institutional order flow. What looks like a break in structure, this is an example, by the way, and this is why it's really important to keep an eye on the high time frame key levels. What looks like a break in structure on the daily chart is just a retracement to an FVG on the weekly time frame. And this is where a lot of people lose sight of the narrative that's really going on in the market. They say they're looking at the high time frame chart, but they're just looking at a daily chart. You can't just look at a daily chart. If you do that, you will get wrecked because you won't be able to keep in alignment with what's really going on. Right now, here's an example of that. Right, so if we look at this here on the NASDAQ, and we're looking at price here, right? We've obviously taken out buy side liquidity here. We've traded up higher, and then it's expanding extremely aggressively here. So if you were to look at price here, what do you see here? Right? You see buy side liquidity taken here. We run up above the high one more time, and then we see a massive expansion down. For a value gap in here, potentially going to run out this low, right? Looks very bearish here. Now what does it look like? Right, not so bearish anymore, not bearish at all. But on the daily chart, it looks extremely bearish. But when you zoom out just one time frame to the weekly chart, this becomes the narrative. Now you're not bearish at all, right? So this is where a lot of traders lose sight, and they start thinking just because they're on a daily chart, that means they're on a higher time frame chart, and this is all they need to frame a narrative and bias. And if you do that, you'll end up seeing moves like this and not knowing what's going on, when on the weekly chart, it's extremely clear to what is actually playing out and the narrative behind us here. Okay, then we trade into the weekly for value gap, and this is then what happens. And you're offside and you miss all of this move simply because you weren't in one time frame higher on the weekly chart, because you think just the daily chart is enough to derive higher time frame buys. It's not. Trade into the weekly FVG, we get candle closure, swing low forms, big bullish day here for value gap forms. At this point, if you were just looking at a daily chart, this is when you'd be bullish, right? But as soon as you get the candle closure here, understanding the weekly chart and keeping an eye on it, you're bullish from here, right? Because candle closure here, wick below, low higher prices, right? So you're bullish from here instead of getting wrecked within this bearish for value gap. Okay, now this is how the higher time frame key levels play off of each other, and this is why you need to map them out on your chart. Right, so we go into an old high key level here, gets traded to, we form a swing high, right, which means we then have a discount low to premium high, volume imbalance then forms, okay, and we have a discount FVG here, well, not in discount but in premium still, which makes it a high probability to draw to, and we go from daily VI, high time frame key level, so a premium key level, to discount key level with the OB and FVG here. We then inverse this fair value gap right there with this candle's body just slightly closing below. The next day respects the daily IFVG, and then daily IFVG again. So we go from high time frame key level from here to high time frame key level here. Then we inverse this high time frame key level to high time frame key level, right? Super important to understand how these high time frame key levels play off of each other so you can incorporate them. And this is really going to be a big game changer when you're mapping them all out correctly. Okay, here's a rejection block, right? And remember, this has two functions, right? A draw on liquidity to trade to, and an area to reverse from as a key level, right? So from this low, okay, to this high, this is a discount market. This is a premium market. So this is a premium weekly rejection block. We trade into discount. We run out a short-term low here, and then the market sees a displacement forming a daily fair value gap, higher time frame key level. So you go from a discount key level, right, to frame your trades to a weekly key level. Then once we hit the weekly key level, that can be used for reversal, and then the market sells off from that weekly key level. Okay, example here on the monthly chart. Discount low, premium high. We run out the old high, key level, right? We get candle closure within this, right? So we're looking for lower prices now. There's other reasons why we'd be looking for lower prices, which we'll go into in the next lessons. Then we see the market sell off aggressively to where? An opposing higher time frame key level. So premium key level, old high, to discount key level, fair value gap. Also external to internal range liquidity. Okay, this is what it looks like on a weekly now. Now we're breaking down the higher time frame key levels. We've gone from a monthly, we're at a weekly now. So monthly key level with the old high, and a monthly fair value gap as the drawn liquidity. The market then trades up into the old high. On a monthly, we start to break lower. We trade higher above a swing high here on the weekly time frame. Continuation purge. We close below the collection of down close candles here. Can be used as an order block, higher time frame key level. Market then expands lower. We then form a weekly fair value gap, right? And then we trade up into the weekly fair value gap, and we use that weekly fair value gap to murder the lows. Okay, now on a daily chart, more opportunities being framed from a monthly, weekly, daily, right? So as we go above that weekly swing high, we then close down below the new day opening gap and below this fair value gap, right? So in bearish institutional order flow, bullish fair value gaps are going to get inversed, right? So we inverse this here, we trade back up into the new day opening gap, we use it as resistance, right? So we've gone from support to resistance, right? True inversion. Market then sells off aggressively, takes out a short-term low, trades back up into a higher time frame key level, external to internal. We sell off another higher time frame key level. Market drops. There is a short-term low here that we take out. We can expect the market to trade back up into the weekly FVG. Remember, we had that mapped. Higher time frame key level used here as a daily order block once we closed above here to trade into another high time frame key level, right? So drawn liquidity with the weekly FVG, as well as an area where it can reverse from. Starts to decline, takes out external then, massive move from the weekly FVG. We could have caught all of this. Then it trades back up into internal, high time frame key level. Then it sells off aggressively until we get to that monthly FVG. Okay, now we're in a discount at that monthly bullish FVG. We run out a short-term low into that bullish FVG. So this is inducement for the high time frame key level. Then we drop to a weekly chart, right? And on a weekly chart, we can see we hit that monthly FVG, strong reaction, right? Then we have this one candle, right? We trade below it here, we wick below. So the previous weekly low, right, old low, is a high time frame key level. So that could be a framework for longs if we drop to a lower time frame daily chart. And then once we close above this down close candle, it becomes an order block, a high time frame key level, right? And then we trade up higher, weekly OB here, which we use to trade up above the relative equal highs and create new all-time highs, right? So now let's look at this here on the daily chart. So once we've run out the previous weekly low here, we then get displacement, right? And a close above this down close candle. This becomes a higher time frame key level that we can use to trade in line with the bias. So the fair value gap holds here. We then continue higher. We confirmed the weekly OB and we have a volume imbalance within it, right? So a PD array within a higher time frame PD array, making this higher probability. Once we expand through another high time frame key level, fair value gap, weekly OB, daily OB here, right? daily fair value gap expands higher. Then we're sitting inside of a weekly OB, which we confirmed with the close above the bodies. We trade back down into it, running out daily stops into the weekly order block, making it very high probability expand higher, daily fair value gap, and then the market expands. So you can see how these higher time frame key levels are playing off of each other relative to premium and discount, and they're acting as both a draw on liquidity as well as a actual key level to go long or short from. So really important when we're looking at this to derive higher time frame bias and where our entries can form, right? And that constant ebb and flow of price moving from premium to discount.